Welcome back to the deep dive. It is January 18th, 2026.
Right.
And if you've taken a look at your portfolio or just, scrolled through the news headlines lately, you know the economy is in a frankly weird place.
Oh, weird is putting it mildly.
We are smack in the middle of these really aggressive tariff wars. They kicked into high gear last year. Inflation is still sticking around like gum on the bottom of your shoe, and the consumer base is completely fractured.
It is a chaotic landscape. I mean, you have one group of people still buying luxury goods like nothing ever happened, and then another massive group pinching every single penny, trading down, hunting for value.
And completely bifurcated.
A total mess.
Exactly. And right in the middle of this mess, we are looking at a retailer that, on paper, really shouldn't be winning right now.
Not at all.
Their stores are often a mess.
And that's by design.
Intentionally so, as we'll find out. They have almost zero e-commerce presence. You literally cannot buy their stuff online.
Which is crazy in 2026.
Right. And their supply chain is heavily exposed to Chinese manufacturing, which you'd think would be a death sentence in this current tariff environment.
By every rule of modern retail, digital first, seamless experience, diversified supply chain, they should be struggling.
And yet, they are hitting all-time stock highs. We are talking about ROST stores, ticker symbol ROST.
ROST.
So the core paradox we need to solve today is how? How does a rummage sale model survive a trade war and, frankly, outpace high-tech competitors?
That is the multi-billion-dollar question. And I think, we should probably start with a bit of a spoiler just to frame the conversation so you know where we are headed.
Okay, let's hear it. What's the verdict?
After tearing apart all the data, the packway strategy, the leadership changes, the valuation models, my conclusion is this. ROST is the ultimate defensive fortress for capital.
Okay.
Technically speaking, it is a grade A business. It's a machine. But, and this is a really big but, the price you have to pay for it today, that might be a grade C.
Interesting. So it's a Ferrari engine, but the dealer is asking for a markup that makes your eyes water.
That's it, exactly. The market might be mistaking past resilience for future immunity. So our mission today is a forensic dismantling of ROST stores.
I like that. A forensic dismantling.
We're not just looking at the stock chart, we're looking at the gears. We're going to talk about the off-price model, the massive leadership transition happening right now, the tariff exposure, and why this stock is trading at 30 times earnings.
All right, let's get into the gears. Part 1, chapters 1 to 3, Business, Management, and Financials. Chapter 1, Business Understanding. So to understand ROST, you have to understand that they don't play the same game as, say, a Macy's or a Nordstrom.
No, it's a completely different sport. To understand why ROST wins, you first have to understand how a traditional department store loses.
Okay.
A traditional store works on this rigid, terrifying calendar. They order their fall collection 9 months in advance.
9 months. That seems like a lifetime in fashion.
It is. They sign contracts, they lock in styles, they commit to fabrics, and then they just pray that purple is still the in color when the shipment finally arrives.
It's a massive bet on the future.
A huge bet. And if they guess wrong, they're stuck with a warehouse full of purple sweaters that nobody wants.
And that's when you see the 70% off signs.
Precisely. And they have to mark them all down, which just destroys their margins. ROST operates on the complete opposite end of that spectrum. They use a chase strategy.
A chase strategy?
Yeah, they don't predict the trends. They exploit the mistakes of the people who tried to predict the trends.
I love that phrasing, exploiting mistakes. It sounds almost predatory, but in a business sense, it's brilliant.
It's financial arbitrage, really. Think of it this way. Ralph Lauren or Nike, they overproduce a line of sneakers.
It happens all the time.
Or maybe a big department store cancels an order at the last minute because, sales are soft. Suddenly, the manufacturer is sitting on thousands of units of inventory that they need to turn into cash. Immediately, they're distressed.
And that's when Ross's phone rings.
That's when ROST steps in. They're essentially a liquidity provider for these desperate vendors.
Like a bank for inventory.
Exactly like a bank for inventory. They say, we'll take it all. We'll take every single box you have, but we are paying you 70 cents on the dollar.
And because Ross has the cash and the scale, the vendor has to say yes just to stop the bleeding.
They have no choice. And that leads directly to the off-price model. They get the branded goods, and that is key. It's not generic stuff. It's branded at a massive discount. So they can turn around and sell it to you for 20 to 60% less than the mall.
Now, you mentioned something in the intro that I think trips a lot of people up. Ross has basically no e-commerce.
None.
In 2026, where I can order a toothbrush and have it delivered by drone in an hour, that sounds like insanity.
It sounds like a bug, but it is actually their best feature. It is a strategic moat.
Okay, how is not selling online a feature?
It all comes down to unit economics. Let's say you buy a dress at Ross for $12. The gross margin on that might be $3 or $4.
Right.
Now, try to ship that dress to someone's house. The shipping alone costs $5 or $6.
So you lose money on every single sale.
Exactly. The math just doesn't work for these low price point items. By refusing to do e-commerce, Ross protects its profitability. They force the customer to come into the store.
And that's where the psychology comes in.
And that brings us to the psychology of the treasure hunt.
Oh, the treasure hunt. I know this well. You walk in looking for socks, and you leave with a frying pan, a dog bed, and a winter coat because it was such a good deal.
That is the engine. The chaotic search, the, rummaging, it drives impulse buys. You can't search for size 10 Nike running shoes on a website and just click buy.
You have to hunt for them.
You have to hunt. And when you find them, you get a little dopamine hit. You feel like you won.
And you buy it immediately because you know if you come back tomorrow, it'll be gone. It creates this sense of urgency that a website just can't replicate.
Scarcity drives conversion. 100%. Now, there is one more secret weapon in their business model that we have to unpack. It's called pack away.
Pack away. This sounds like hoarding.
It is strategic hoarding. It's an arbitrage of time. Let's say it's January.
Oh,
Department stores are clearing out their winter coats to make room for spring swimsuits. They are desperate to get rid of them.
right. Nobody buys a parka in January unless it's 70% off.
So Ross buyers step in. They buy the winter coats for pennies on the dollar, but instead of putting them on the rack immediately, where they would have to sell them cheap, they pack them away
Wait.
in their massive distribution centers. They just sit on them for 9 months.
So they're paying to store them.
Yes, but the storage cost is negligible compared to the savings. Then, come October, they release those coats into the stores. They locked in the price back in January.
So even if inflation has driven up the cost of cotton or shipping.
It doesn't matter.
Yeah.
Ross's cost of goods sold their COGS is locked in at that rock-bottom January rate.
That is brilliant. It's like time travel for inventory pricing.
It effectively insulates them from short-term inflationary spikes. It preserves their margins when everyone else is getting squeezed.
So we have the chase model, the lack of e-commerce, and pack away. Let's talk about the scale of this operation, because you can't do this if you're a small shop.
No, scale is the moat. As of late 2025, they have about 2,273 locations between Ross and their other brand, DD's Discounts.
And they're still growing.
Oh, yeah. They are targeting 2,900 Ross stores and 700 BDs. And what's interesting is they are still underpenetrated in the Midwest and the Northeast, so there is room to run.
And that size allows them to negotiate with vendors.
Negotiate is the polite word. But yes, to get a meeting with Nike or Calvin Klein, you need billions in purchasing power. Ross acts as a massive clearinghouse.
The only game in town for that kind of volume.
If you are a manufacturer with 1 million excess t-shirts, you can't call a boutique. You call Ross because they can write the check.
And they run these stores so cheap. No frills is an understatement.
It is austere. No mannequins, no fancy lighting, minimal staff. This keeps their SG&A, their selling, general, and administrative expenses incredibly low. That cost discipline is what allows them to sell cheap and still make a profit.
It's a network effect too, isn't it? More stores mean more buying power.
Which means better deals.
Which brings in more customers.
Yeah, which funds more stores. It is a classic flywheel.
Chapter 2, Management Evaluation. Okay, let's shift gears to the people running this machine. Because, frankly, 2026 is a huge year for Ross management. There is a changing of the guard happening right now.
This is critical context. For the last 12 years, since 2014, the ship has been steered by Barbara Rentler. She is, by all accounts, a retail legend.
A legend.
She navigated the retail apocalypse when everyone thought Amazon would kill physical stores. She got them through COVID. She built the fortress we see today.
And now she's stepping down.
As of February 2026, so next month, she moves to an advisory role. The new CEO is Jim Conroy.
Who comes from Boot Barn, right? So that feels like a very specific choice.
It is. And generally, the market sees this as a good thing. He's a retail operator. He knows how to grow a specialty footprint.
He's not some finance guy.
Right. He's not some finance guy dropped in from a hedge fund. He understands store operations. He grew Boot Barn significantly, and that required a similar operational discipline.
But, and here's where it gets a little spicy, there's been some selling of stock.
Yes. In September 2025, just a few months ago, Jim Conroy sold about $5.7 million worth of stock.
How much was that?
That was roughly 20% of his holdings.
Now, if I'm a listener holding RS shares, seeing the new CEO dump 20% of his stake right before taking the full reins, that feels like a red flag.
It is a yellow flag. You have to be careful interpreting insider sales. I mean, sometimes people just need to buy a house or pay taxes.
Yeah.
And Barbara Rentler sold some too, which makes sense as she's retiring.
Sure.
But combined with the all-time high stock price, it does suggest that the people who know the numbers best don't think the stock is undervalued right now. They are taking chips off the table.
Right. If they thought the stock was going to double in the next year, they probably wouldn't be selling.
Probably not.
Now, corporate culture-wise, how do they manage expectations?
They are notoriously conservative. Their guidance style is underpromise and overdeliver. For example, look at Q3 2025. They gave this very conservative guidance, then beat earnings per share came in at $1.58 versus the expected $1.41.
They like to sandbag the numbers.
They do, so they can surprise to the upside. Wall Street likes that.
Let's talk about capital allocation. ROST itself is a massive buyer of its own stock.
They are a cannibal.
Cannibal.
It's a term Charlie Munger used, a company that eats itself by buying back shares. ROST has a $2.1 billion buyback authorization. In the third quarter of 2025 alone, they bought back $262 million.
And for the listener who might not be a finance whiz, why do we like this?
It reduces the number of slices in the pizza. If the company makes the same amount of profit but there are fewer shares, your slice of the profit, your earnings per share goes up.
So it's a way to boost growth.
An artificial way, but a very effective way for shareholders.
Plus, they pay a dividend.
Yes, they are a dividend achiever. Currently paying about 40.5 cents per share quarterly. They raise it consistently. It shows financial discipline.
I want to touch on one specific metric before we move on. ROIC, return on invested capital. You always say this is the one number that actually matters.
It is the holy grail. It really is. ROST has an ROIC of about 22% to 24%.
Okay, unpack that. What does that mean?
It means for every dollar they invest, building a store, buying inventory, they get 24 cents of profit back year after year. Now compare that to their cost of capital.
The money they have to pay to get the money.
Exactly. The interest they pay on debt and the return shareholders expect. Their WACC weighted average cost of capital is about 9.6%.
So they pay 9.6% to get the money, and they earn 24% on the money.
Exactly. That spread, about 12%, is pure value creation. As long as that spread exists, every new store they open is literally printing wealth.
Wow.
Most retailers are happy with a 2% or 3% spread. ROST is a compounding machine.
Chapter 3, Financial Health. Let's get into the hard numbers, the scorecard. We've established the business is great, the management is solid, but maybe cashing out a bit. What does the balance sheet look like here in January 2026?
It's a fortress. The market cap is around $62 billion. Revenue, trailing 12 months, is about $22 billion. But here is the reality check. The 5-year revenue growth rate is only 5.7%.
0.7%. That's
okay.
It's not exactly tech growth.
No, it's GDP plus. It's not a tech stock. This is not NVIDIA. They are growing by adding square footage and inching up sales. It is steady, boring growth.
What about margins? With all the inflation we've talked about.
Surprisingly healthy. Gross margins are holding at 27-28%. The net margin is around 9-10%.
Which means?
It means for every $100 they sell, they keep $10 of pure profit. In retail, where competition is just fierce, keeping a dime on every dollar is actually very impressive.
In cash flow.
Cash is king. Free cash flow in 2025 was around $1.72 billion. They generate far more cash than they need to run the business.
Which fuels the buybacks.
That's why they can afford those buybacks we talked about.
Okay, so here's the elephant in the room, the valuation. We are looking at the stock price of $192.36.
And this is where the argument gets heated. The PE ratio, price to earnings, is sitting at roughly 30x.
30 times earnings for a company growing at 6%.
It is extremely rich. Historically, ROST trades at 20 to 25 times earnings. A 30x multiple is usually reserved for, high-growth tech companies or businesses that are doubling every few years.
So why is the market paying this premium? What's the logic?
Safety. Investors are scared of the economy. They look at ROST and see a company that survived the pandemic, survives inflation, and keeps growing. They are paying a safety premium. They treat it almost like a bond that grows.
But mathematically?
Mathematically, it's hard to justify.
What do the models say if we strip away the emotion and just do a discounted cash flow analysis?
If you run a DCF analysis using reasonable assumptions, The fair value comes out somewhere between $120 on the bearish side and maybe $164 on the bullish side.
And the stock is at $192.
Right. So the math suggests the stock is overvalued by anywhere from 15% to 37%. There is no margin of safety here.
No room for error.
None. If you buy at $192, you are betting that everything goes perfectly forever.
That feels precarious.
It is. You are buying a great house in a great neighborhood, but you are paying 40% over the asking price. It might still be a good house, but it's bad investment.
Part 2, Chapters 4 to 7, Market Sentiment, Ownership Risk, and Final Conclusion. Before we see what the market thinks of that high price and dive into the specific risks facing ROST in 2026, we have a quick recommendation for you. Like and subscribe to Stock Analytics AI. Want institutional-grade stock research without the institutional price tag? Check out stockanalytics.ai.
For just $10 a month, you get full access to our deep dive video library covering over 500 S&P 500 and Nasdaq 100 stocks, each with full source citations you can verify.
Can't find the stock you're looking for? Request analysis on A&Y ticker and we'll deliver it within 24 hours.
Upgrade to Pro for $20 a month and unlock our SEC Risk Scanner, which detects red flags in company filings before they hit the headlines, plus our Portfolio Diversification Analyzer to optimize your holdings.
Start your 7-day free trial today at stockanalytics.ai. Make smarter investment decisions with research you can trust. Chapter 4, Market Sentiment. Okay, we're back. We just said the math says the stock is overvalued, but the market clearly disagrees because the chart is going up and to the right. What is the sentiment on Wall Street?
There is a massive disconnect here. It's fascinating. The consensus rating from analysts is a moderate buy.
Okay, so they like it.
They like it, but if you look at the price targets, the average analyst target is around $186.
Wait, the target is $186, but the stock is trading at $192.
Exactly. The stock has run faster than the analysts can update their spreadsheets. It has momentum. It's trading above its target.
Which usually means a pullback is coming.
It should. The analysts are essentially saying, we like it, but not at this price.
But the stock just keeps climbing the wall of worry.
It does. Think back to May of 2025. Headlines were screaming about tariffs. Ross even withdrew guidance briefly because of the uncertainty. The stock dipped.
And then what happened?
And then it ripped right back up.
Why?
Because the market realized Ross has pricing power. The logic is, if tariffs hit, Ross can push some of those costs to vendors or even to consumers. And even if prices go up a little at Ross, they are going up even more at Macy's.
Ross is still the cheaper option. It's relative value.
Exactly. In an inflationary world, the cheapest option usually wins.
What about the short sellers? Is anyone betting against this?
Almost no one. The short interest is tiny, about 2.6%.
Why? If it's so overvalued, shouldn't the sharks be circling?
Because shorting a company that buys back $2 billion of its own stock is suicide.
You're fighting the company itself.
You are stepping in front of a freight train. Plus, in a recession, Ross tends to outperform. So if the economy crashes, your short position blows up. If the economy booms, the stock goes up. It's a widowmaker trade. It's a terrible candidate for shorting.
So the technicals look strong. We have a golden cross configuration, right?
We do. The 50-day moving average is well above the 200-day. Momentum traders are just piling in because the chart looks good, regardless of the PE ratio. The trend is your friend until it isn't.
Chapter 5, Ownership Structure. Let's look at who is actually holding the bag here, or holding the treasure chest, depending on how you look at it.
It is institutional dominance. About 94% of Ross stock is owned by institutions.
94%. So retail investors like us are basically a rounding error.
We are irrelevant to the price action. But here's the key insight, the passive floor.
Explain that.
Vanguard owns about 12%. BlackRock owns about 7.6%. These aren't active stock pickers sitting in a room deciding Ross is a good buy at $192.
You're not making a choice.
No, these are index funds, ETFs.
Right. If I buy an S&P 500 ETF, BlackRock has to go out and buy ROST stock.
Exactly. They buy mindlessly based on inflows. This provides a massive, stable floor for the stock price. Even if the valuation makes no sense, the passive money keeps bidding it up as long as the overall market is rising.
It effectively distorts the price discovery mechanism.
It does. It absolutely does. It means the stock can stay overvalued for a very, very long time because the biggest buyers aren't price sensitive.
Which explains why the price can detach from the fundamentals. What about the insiders again? Just to recap the ownership there.
Insiders own about 2.2%. That's about $1.3 billion, so they are definitely aligned with shareholders.
That's good.
But again, the recent selling by Rentler and Conroy is the only crack in the armor. They are selling into this passive buying pressure. They are selling to the index funds.
Chapter 6. Risk Assessment. We've painted a pretty rosy picture of a resilient company, but this is a deep dive, and we need to look at the dark side.
Yeah.
What could actually derail this train in 2026?
The biggest threat, without question, is the tariff war.
Let's drill down on this. We know tariffs are high. How exposed is ROST, really?
ROST imports roughly 50% of its merchandise directly or indirectly from China.
50%. That is a massive exposure.
It is. Now, they don't own the factories, but their vendors do. If the U.S. government slaps a 60% or, 100% tariff on Chinese apparel, which is on the table, that cost has to go somewhere.
Right. Either ROST eats it and margins crash, or they raise prices and customers leave.
Or they try to force the vendor to eat it. But there's a limit to how much you can squeeze a vendor before they go bankrupt.
And what's their plan?
ROST is mitigating this by moving sourcing to Vietnam, India, and Pakistan. But you can't move a supply chain overnight. It takes years.
So if a heavy tariff hits tomorrow, their margins take a direct hit.
Correct. It would compress that beautiful ROIC spread we talked about earlier.
Risk number 2, the no e-commerce vulnerability. You said it was a feature, but isn't it also a weakness?
It is a single point of failure. If we have another pandemic or a major climate event or anything that physically closes stores, ROS's revenue goes to zero, instantly.
Competitors like TJ Maxx have at least a small online presence. ROS has nothing.
Correct. It's a high-wire act. They're betting everything on the physical store remaining open and accessible. There is no digital backup plan.
Okay, risk number 3.
The store experience versus demographics. Look, Gen Z loves the deal, but they also value aesthetics and convenience.
And ROS stores are.
Let's be charitable. Messy.
It's a rummage sale.
It is. And as the consumer evolves, there's a risk that the messy store concept stops feeling like a treasure hunt and starts feeling like a chore. Plus, you have labor shortages. These stores run lean.
Very lean.
If the minimum wage spikes or they can't find workers, the checkout lines get longer, the mess gets worse, and the brand suffers.
And finally, supply chain disruption.
The Chase model relies on speed. If there is a conflict in the Red Sea or the South China Sea, and those container ships get delayed.
The winter coats arrive in March.
And the arbitrage fails. You can't sell winter coats in March. You have to pack them away for another whole year, tying up capital and warehouse space. The whole model relies on the fluid movement of goods. If those gears jam, the machine stops.
Chapter 7. Conclusion. All right, we have dismantled the engine. We've looked at the chase strategy, the pack-away arbitrage, the fortress balance sheet, and the nosebleed valuation. It's time for a verdict.
Let's synthesize this. Let's put it all together.
Give me the bull case first, the Buffett argument for owning ROS.
The bull case is simple. ROS has a wide moat built on scale. They have an ROIC of 22%, which is elite. They generate $1.7 billion in free cash flow. And historically, they are the best stock to own in a recession because everyone trades down to them. If you believe the economy is crashing, you want to own ROS because it is a bunker.
And the bear case. The other side of the coin.
The bear case is entirely about price. That's it. You are paying 30 times earnings for a company with single-digit growth. You are paying for perfection in a world that is very imperfect. With tariffs, leadership changes, and supply chain risks, you are buying a defensive stock at a growth stock price.
So what is the final verdict? Buy, sell, or hold?
My rating is neutral hold.
Elaborate on that.
ROS is a wonderful company trading at a euphoric price. The market has priced in all the good news and completely ignored the tariff risks.
So what is the strategy for the listener? What's the actionable advice?
Put it on your watch list. Do not chase it here at $192. Wait for a market panic. Wait for a headline about tariffs that scares the algorithms.
What's the price target? When do we pull the trigger?
I'd start getting interested in the $150 range.
$150. That's a significant drop from here.
It is. But at $150, you actually have a margin of safety. At $150, the risk-reward flips back in your favor. Right now, at $192, you are just holding a hot potato.
It brings us back to that old investing adage. Even the best ship isn't a good buy if you pay too much for the ticket.
Exactly. ROS is a great ship, but the ticket is just too expensive right now.
There you have it. A forensic look at ROS stores in 2026. A grade A business with a grade C price tag.
Keep your powder dry on this one.
That's a wrap for this deep dive. If you enjoyed this breakdown, make sure to subscribe to Stock Analytics AI, We are doing this every single day, uncovering the stories the charts don't tell you.
And remember, knowledge is only power if you act on it prudently.
Exactly. Before we go, a quick reminder. This analysis was generated by an AI system for educational purposes and should not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions.
Thanks for listening.
See you on next dive.